Capital gains tax. Capital gains tax, or CGT, is a tax on profit made from the sale of assets such as property, shares, cars, or valuable antiques. There are three important things to know about CGT. Firstly, CGT isn't payable on death. That's because any increases in the value of assets owned by the deceased during their life are effectively wiped out when they die, meaning the estate receives assets valued at the date of death. Secondly, CGT is payable on any increase in value after the date of death. If an asset is sold while the estate is being administered, any increase is classed as a gain made by the estate, and the personal representatives, PRs, need to pay CGT on this. There's an annual allowance for CGT available to PRs, just as there is for any individual, and you'll need to look at the overall gains and losses of the estate to work out any CGT liability. Thirdly, CGT liability can sometimes be reduced through careful planning, for example by timing the sale of assets so they fall into different tax years, or transferring assets to beneficiaries in order to make use of their personal annual CGT allowances. This is especially important where charities are beneficiaries. Visit our Knowledge Centre for more information about CGT. Important points. To calculate the deceased CGT liability, you need an accurate valuation of their assets at the date of their death. Undervaluing shares, property, or other valuable personal possessions puts you and the estate at risk. For example, when valuing properties, there's often a range of opinion about what the property is worth. PRs often think a low valuation is better as it reduces the value of the estate for inheritance tax purposes. However, if the property is later sold for far more, the estate will be liable to pay CGT. The amount of CGT due depends on the increase in value, so using a low valuation means you may end up paying more CGT than if you'd used a higher, more accurate valuation in the first place. In this situation, beneficiaries may feel it's your fault more CGT is payable. As the money to pay CGT comes from the estate, the beneficiaries might sue you for the loss they've suffered. It's therefore essential you make sure whoever provides the valuation is as accurate as possible and understands the importance of giving a true figure. See our video on professional property valuations for more information. Will CGT be an issue in my case? The short answer is, that depends. The first step is to get an accurate date of death valuation of the estate's assets before you sell them. If there's an overall increase above the annual allowance, you'll need to think about CGT. If there's no increase or even a loss, then CGT won't be an issue for you. DIY Probate can help you keep track of CGT by recording the probate value of assets so you can easily compare them to current values and therefore get a true picture of any gains or losses. You can also record the assets as sale prices, which make completing a CGT return far easier. Top tip: if you've got an estate with property and shares, remember to keep an eye on the values of both, as all gains and losses in the tax year count towards the CGT liability of the estate.